One pension decision can affect the next 20 to 30 years of your financial security. Banks and institutions don't always fully explain pensions and LIRAs, and this is something that affects millions of Canadians going into retirement. Today, we're going to talk about a few things that banks and financial institutions don't tell you when it comes to your retirement and making these permanent decisions. My name is Zach Sutton. I'm a senior financial planner at Odyssey Wealth, an independent wealth management firm that specializes in helping Canadians get ready for retirement confidently. I'm a certified financial planning professional, which means that I have a fiduciary responsibility to put your needs first. I'm also life licensed and a registered representative of Designed Wealth, with investment services provided through Designed Wealth, a CIRO-regulated dealer. Before we talk about the mistakes or hidden risk, we need to start with the basics. Let's talk about what a LIRA really is and why it exists. A LIRA stands for a locked-in retirement account. It was created to hold pension money when someone leaves or retires from a company. Decades ago, many Canadians only worked for one employer for their entire career and simply collected a pension when they retired. But as you know, things have changed. As careers became more mobile and people started moving around, governments needed a way to protect pension savings when employees left those plans. That's where LIRAs were created. A LIRA allows pension funds to be transferred out of an employer-sponsored pension plan while still preserving the retirement purpose of that money. The key word is locked in, which means generally the funds can't be withdrawn like an RRSP. More on that later. LIRAs exist to protect retirement income, but often come with lots of rules and regulations and restrictions that many Canadians don't understand until it's too late. When deciding what to do with your money, it's extremely important to understand that not all pensions are created the same. There are two main types of pension plans in Canada. The first is a defined benefit pension, often called a DB pension. A defined benefit pension promises you a predictable income for life based on a formula. That formula usually considers your salary, years of service, and sometimes your age at retirement. The employer takes responsibility for investment performance and longevity risk. In simple terms, the employer guarantees the income and you receive stable, predictable payments for life. The second type is a defined contribution pension, or DC pension for short. With a defined contribution pension, the employer and employee contribute money into an investment account, but there is no guaranteed income. The retirement outcome depends entirely on how these investments perform over time. The risk and opportunity sits with the employee rather than the employer. We're seeing this type of pension become more and more popular and the DB pension becoming almost archaic because employers, let's face it, would rather you hold on to the risk rather than them. Understanding which type of pension you have is critical because it will determine whether transferring your pension even makes sense. When someone leaves a pension plan, they're often given the option to commute the pension, which means taking the value of future payments in a lump sum today. This lump sum is called the commuted value. Let's pay close attention because this is where many Canadians get surprised. Government rules limit how much of that commuted value can be transferred into a LIRA. The portion that fits within those limits goes into the LIRA and remains tax deferred. But any amount above that limit must be paid out as cash, and that cash is immediately taxable as income. And I mean immediately. Typically, we see the taxable amount being at 30%, but oftentimes Canadians forget to realize that that amount of cash also has to get added onto their income for the year, which could drastically change the tax implications. Oftentimes it means that if they haven't put enough money aside, they're in for a rude awakening when it comes to tax time. They say in life, the only things that are true and constant are death and taxes. And we know the government, especially in Canada, wants their pound of flesh when it comes to taxes. Depending on the size of the pension, this can push someone into a significantly higher tax bracket, trigger government benefit reductions, or create unexpected tax installment obligations, as I just mentioned. I've seen people focus on the size of their LIRA without realizing how much tax exposure was created by the tax portion. So here are the 5 things that banks don't always talk about when it comes to pensions and your LIRA. The first one is the tax trap. When people commute their pensions, they oftentimes focus on the lump sum and not the after-tax reality, as just discussed. The taxable portion can create immediate tax consequences and long-term impacts, including potential OAS clawbacks and loss of income-tested benefit. Without proper planning, this is one of the most common retirement mistakes Canadians make. Point number 2, and this is one that I know they really don't like to talk about. Sometimes leaving your pension where it is exactly the right thing to do. There's a strong assumption that transferring your pension out automatically gives you more control and therefore is the best thing to do. Some pensions offer valuable guarantees that are extremely hard to duplicate individually. This can include inflation protection, survivor benefits, and lifetime income regardless of market performance or longevity. Because of this, in many situations, leaving a pension exactly where it is the most efficient and safest way to move into retirement. The third point is you actually have 3 legitimate retirement options. Option 1 would be leaving the pension where it is. Option 2 would be commuting the pension. And option 3 would be a life annuity. When someone leaves a pension plan, there are generally 3 paths that they should be shown. The first option is leaving the pension plan in place and receiving guaranteed lifetime income. The second option is transferring the pension value into a LIRA and manage the investments independently. This provides flexibility and control, but transfers investments and longevity risk directly to the retiree. The third option is using some or all of the funds to create guaranteed income through an annuity, which can balance certainty with flexibility. The challenge is that many Canadians are only presented with one of these options when they should be presented with all 3. And sometimes you have to wonder why. Many times these banks and financial institutions aren't able to offer annuities and only focus on bringing in the LIRA, commuting it in, as we talked about before, and don't know enough about pensions to be able to speak and educate the general public on that. This doesn't mean that these people are out to get you. Oftentimes, the institutions that they work for place limitations that they cannot work outside of. And how do I know this? Because I used to work for a bank and some of those financial institutions. Point 4. A LIRA is not an RRSP. Many Canadians believe that once money moves into a LIRA, it operates like an RRSP, but that's not the case. LIRAs have strict withdrawal rules, provincial variations, age-based restrictions, and eventually converts into a LIV, which has both minimum and maximum withdrawal limits. Why is this important? Because the restrictions directly impact retirement flexibility and income planning. These restrictions directly impact retirement planning and flexibility. Once these structures are chosen, it often becomes very difficult to reverse. Point 5. Retirement success is about income and not returns. During accumulation years, which are the years before retirement, investment returns play a huge portion in getting you ready for retirement. Now, while that still is the case in retirement, a bigger focus is on income because that's what you're taking in. Retirees don't live on account balances, they live on income. As my dad told me growing up, it really doesn't matter how much you make, it's how much you can actually take in. Sustainable tax-efficient withdrawal strategies, coordination with CPP and OAS, and protection against sequence of returns risk often matter far more than chasing higher returns. You don't retire on performance, you retire on reliable income. Point 6. Structural limitations do exist. What I honestly believe is that most advisors are generally trying to help their clients. However, large institutions often limit what these advisors can offer their clients. Things like proprietary products, closed product shelf, and the inability to offer things like an annuity oftentimes will hamstring you and handcuff you without you knowing into a specific path, even though there are multiple options. Independent advisory firms like Odyssey generally have access to a broader range of tools, which allows for more objective planning and comparisons. This isn't about good or bad advisors. This is about giving Canadians the full freedom to choose the option that is best for them. As you approach retirement, you're going to be faced with making some very important decisions, which in most likelihood are going to be permanent. So what I'm trying to say is, get a second opinion. I think we can all agree that as you're going into retirement, or if you're already there, you're going to or have already made some very important decisions that often will have permanent consequences. If you're within a few years of retirement and want to better understand your pension or LIRA options, getting a second opinion can provide clarity and confidence before making irreversible choices. At Odyssey Wealth, we specialize in helping Canadians transition beyond institutional limitations and build retirement plans focused on long-term stability and flexibility. As always, I'm Zach, one half of the Odyssey boys. Peace, much love, God bless.